In 1929, stocks collapsed and wiped out millions overnight. In 2008, banks melted down as opaque debt triggered a global panic. Today, consumer and government debt are at record highs. Corporate defaults are rising, and the financial system is more leveraged than ever. If history's 100-year crash cycle holds, the next economic shock could be even more devastating. What signal is everyone missing this time, and how close are we to the breaking point? Wall Street in the late 1920s ran on borrowed money. With just 10% down, investors could control 10 times their cash in stocks. $1,000 opened the door to $10,000 in shares, thanks to the broker call loan system. This easy credit drew in a wave of new investors, each one convinced the market would never turn against them. By October 1929, margin buying had become the engine of the boom, but it was also a powder keg. As rumors of trouble spread, banks hiked the call money rate, what brokers paid to keep those loans afloat. On October 24th, the rate shot up to 20%, a cost that made holding leveraged positions nearly impossible. Brokers began issuing frantic margin calls demanding more cash from their clients overnight. For many, there was nothing left to give. Forced selling swept through the market, driving prices even lower and triggering more margin calls in a vicious loop. Irving Fisher, one of the most respected economists of the era, had just declared that stocks had reached a permanently high plateau. Instead, the system that let ordinary people gamble with borrowed money now threatened to wipe them out. On October 29th, liquidation orders flooded the exchanges. Years of savings vanished in hours. The promise of easy wealth had turned almost instantly into a trap no one could escape. As the dust settled on Wall Street, the damage spread far beyond the trading floor. Forced liquidations meant banks suddenly found themselves holding mountains of devalued stock as collateral, assets that no longer covered what was owed. Hundreds of banks, especially small-town lenders, could not withstand the losses. By the end of 1930, over 1,300 banks had failed. But the collapse was just beginning. With each new wave of closures, panic grew. Depositors lined up outside shuttered doors, hoping for a chance to reclaim their savings. Most walked away empty-handed. By the spring of 1933, more than 9,000 banks had failed, erasing over $7 billion in deposits. Nearly 1 out of every 3 banks in America vanished in less than 4 years. The consequences were immediate and devastating. Businesses lost access to credit, payrolls dried up, and unemployment soared. In cities and small towns alike, breadlines stretched for blocks. Once stable families lost homes and livelihoods overnight. With no federal insurance, the collapse of a single local bank could wipe out an entire community's savings. The banking crisis turned a market panic into a national disaster, transforming financial loss into daily hardship for millions. The unwinding of leverage did not just erase fortunes, it unraveled the social fabric, leaving scars that would define a generation. By the early 2000s, the dream of home ownership had become the engine of American finance. Banks and mortgage brokers flooded the market with loans, often to borrowers with shaky credit. Over 20% of new mortgages in 2006 were classified as subprime, loans made to those least able to pay them back. But the real transformation happened after the loans were made. Instead of holding on to the risk, lenders bundled thousands of mortgages together, slicing them into pieces called tranches. Each tranche promised a different level of risk and reward, and the riskiest slices were stacked at the bottom. The safest slices, or so investors were told, sat at the top. This process gave rise to a collateralized debt obligation, known as CDO. By mixing high-risk subprime loans with better quality debt, banks convinced ratings agencies to stamp many of these bundles with AAA ratings, the same level reserved for the most reliable government bonds. Investors from around the world snapped them up, believing they were buying safety. Robert Shiller later described the mood. The housing bubble was driven by a mindset that home prices could never go down, that collective optimism set the stage for disaster. In reality, the complexity of CDO structures hid the true risk. As more subprime borrowers defaulted, losses cascaded through the financial system. The packaging that promised stability had, in fact, multiplied the danger. When the music stopped, even the so-called safest tranches were left exposed, and investors discovered that AAA could mean nothing at all. On Sunday, September 14, 2008, the world's biggest banks scrambled behind closed doors. Lehman Brothers, a 158-year-old institution, was out of cash and out of options. By sunrise, no buyer had stepped forward. At 1:45 in the morning on September 15th, Lehman filed for bankruptcy. The announcement landed like a bomb. Within hours, markets across the globe froze. Banks, unsure who held what toxic assets, stopped lending to each other. Overnight, trust, always the lifeblood of finance, simply vanished. Money market funds, long considered the safest place for cash, broke the buck for the first time in decades. Traders rushed to pull billions from short-term lending markets. The cost of borrowing between banks, measured by the LIBOR spread, shot to record highs. Even healthy firms struggled to raise cash, fearing that any counterparty could be the next to fail. The Federal Reserve responded with emergency measures, launching the term auction facility to inject hundreds of billions in liquidity. But the damage had been done. The collapse of a single investment bank had exposed a web of hidden risks, turning a mortgage crisis into a full-blown panic. The system's complexity and opacity meant nobody knew who was safe. In the space of a weekend, financial contagion spread faster than anyone thought possible, and the world's central banks found themselves fighting to keep the entire system from coming apart. Warning lights are flashing across the financial system. U.S. government debt now stands at 130% of gross domestic product, a level never seen outside of world wars. The S&P 500 CAPE ratio has hovered above 30 for 3 years straight, a signal of stretched valuations, last seen before the crashes of 1929 and 2000. Meanwhile, the yield curve has been inverted for more than 24 months, the longest streak on record, an alarm bell that has preceded every major recession in recent memory. Corporate defaults have jumped 35% over the past year, with high-yield borrowers struggling to keep up as credit tightens and interest costs climb. In the banking sector, the digital age has brought a new kind of risk. In March 2023, Silicon Valley Bank lost over $40 billion in deposits in a single day as customers moved money with a tap of their phones. As Ray Dalio warns, we are in the late stage of the long-term debt cycle. Debt burdens and budget deficits are reaching breaking points. Each number signals growing fragility. Together, they point to a system under historic strain. Interest costs on government debt have climbed to levels not seen in modern history. In 2025, the United States paid over $1 trillion just to service its debt, which was more than the entire defense budget. As rates rise, every new dollar borrowed carries a heavier burden, shrinking the room for fiscal maneuver. Banks are running with thinner cushions, with reserve ratios drifting near regulatory minimums. Liquidity, once abundant, now evaporates quickly in moments of stress. Central banks, after years of near-zero rates and massive asset purchases, find their toolkit nearly empty. Milton Friedman once warned that policy lags and limited options can turn a downturn into a disaster. Today, those limits are visible, as rate cuts risk fueling inflation and further tightening could break fragile borrowers. When debt service outpaces growth and reserves run dry, the system enters a four-step chain reaction. Credit dries up, asset prices plunge, banks face withdrawals they cannot meet, and panic spreads. Each constraint magnifies the next, accelerating the path to collapse. Today, global debt stands at over $307 trillion, triple what it was before 2008. As markets grow more fragile and warning signs intensify, the question isn't if cycles repeat, but whether we're willing to break them. Complacency now is the most expensive risk of all.